I'm Anthony Valeri, Director of Investment Management at Zions Bank Corporation. Thank you for joining our fall market outlook. I'll review the economy and financial markets with an eye towards the remainder of 2023. We will have a question and answer session at the end of the prepared remarks, so please do hang on for that. As we begin, as we show the jobs market here, with the monthly payroll growth going back to 2021. Now, the labor market remains healthy after a stronger than expected September employment report. And we did have not only a stronger than expected report, but revisions to the two prior months where they were revised up by 119,000 jobs. Now, prior to that report, the 3-month average of employment had been slowly decelerating or coming down for 2023. But that most recent report changed that trend, and we've seen a healthy labor market, no cracks. And if we look at other measures of the labor market, job openings up to 9.5 million in August. That was stronger than expected. Weekly jobless claims also near a historic low. When you just look for cracks in the labor market, it's not there. And consistent with an economy that is slowing down and achieving, or at least on track to achieve, the soft landing. Within the employment report, we also look at wages. Wages continue to decelerate, and this is going to give comfort to Fed Chair Powell and his cohorts at the Fed. Wage growth slowed to 4.2% annually. This continues to come down. It's still too high for members of the Fed, but together it shows that the Fed's rate hike campaign has so far achieved the goal of lowering inflation without damaging the bond market or the jobs market. So we'll keep a track on that as well. If we look at inflation here too, the message is a good one. Overall, CPI inflation has slowed. The last 2 months, we've seen an increase in overall CPI. That's mostly due to rising oil prices. When you look to the right and core CPI, we see a continued deceleration in core CPI. And again, the Fed's going to take a closer look at this, as well as their preferred measure of inflation, core CPI. This will help, but let's take a look at what we think inflation will project at in the coming months. So the Fed's going to look for a continued slowdown. They're not quite comfortable yet. If we take a look at CPI, and it was 3.7% at the end of August, the monthly increase was 0.2% on a monthly basis over the last 6 months. If we project that out over this coming year, you can see what CPI will go to. And it'll stay in the low threes and eventually fall just below 3% at the current pace. Conversely, if we get an acceleration in inflation, call it a 0.3% increase, you can see that CPI inflation likely will stay level to where it is currently and not see further deceleration. Conversely, if it slows to 0.1, that is a potential path to CPI getting at or below the Fed's target of 2%. But the main point here is that the deceleration is likely to slow. The easy work of the inflation decline is behind us, and will likely be harder from here. So this is what's given the bond market some pause as well. And I'm going to talk more about the bond market a little bit later and the rise in interest rates. Let's shift to two of our favorite leading indicators, top tier indicators on the economy, the ISM surveys. On the left is the ISM manufacturing index, which increased in September. There was a surge of goods spending following the pandemic that quickly fell off, and manufacturing went below 50, which indicates a contraction. That manufacturing index is now going higher, which indicates a potential low or bottom in the manufacturing sector, while services did slow, but they remain in expansion territory. These two indicators together suggest that the economy is likely to continue to grow at the 2 to 3% level. Again, not a recession. The third quarter is actually tracking to 3 to 4%. We don't think that sustains itself. We're going to see a slowdown in economic growth. But both of these indicators projecting about a 2 to 3% GDP growth rate, which we think is reflective of a resilient economy. So economy's been stronger than expected. And if we look at two other staples or pillars of our view on the economy, on the left, consumer spending. Total retail sales have slowed, but have actually picked up over the summer, 2.5% annualized on total retail sales. Other measures tracking closer to 3%. On the right, business investment, and this is the total dollar level of business investment through the durable goods report. And you'll see that although it has also slowed or stopped growing, we haven't seen business investment roll over. Both of these indicators also supportive of the economy and a resilient economy where we see a slowdown, but without a recession. But we don't want to celebrate too early. Doesn't mean the economy is out of the woods yet. There are a number of headwinds that are also reflected in the yield curve. And I think the naysayers will say, well, yield curve doesn't matter this time. Those are dangerous words, that it's different this time. We do have some headwinds: the United Auto Workers strike, the resumption of student loan repayments in September, higher gas prices, near a peak in mortgage rates, and reduced government spending. All of that is going to have an impact on a go-forward basis and why we expect the economy to slow going forward. Let's also not forget the lagged impact of the Fed's aggressive rate hike campaign. The Fed last hiked rates in late July. All of those rate hikes that we saw from late 2022 through 2023 will continue to have an impact. So all of that still a potential impact that could slow the economy and still keeps a recession risk out there. So do keep that in mind, that there could be some challenges ahead for the economy. Let me shift to asset class performance. In the third quarter was a tough one for investors. Most asset classes declined over the third quarter, with only commodities and high yield bonds in positive territory. You can see the other range of investments. Equities declined, with U.S. large caps, the S&P 500 down 3.3%, and bonds and mid-cap stocks also declining. However, if we look at on a year-to-date basis, the story's a little more positive, with several asset classes positive. Bonds, fortunately, back into negative territory after a difficult August and September. I'm going to talk more about this in a moment, but the large cap index there, that's the S&P 500, that performance was dominated by a limited number of stocks. Again, more on that in a moment. But year-to-date, generally positive results for investors, even after a difficult Q3. On a sector basis, energy was the lone bright spot within the equity market. If you look at communication services, that positive outcome was almost entirely due to Google and Meta, or Facebook. And when you look at the rest of the sectors in the S&P 500, not a good story to tell. And two of the defensive sectors, consumer staples and utilities, rounding out two of the bottom three sectors for the S&P 500. Technology was a laggard after outperforming over the first half. So it's more damage under the hood, depending on investors' specific exposure when you look at the equity markets. And speaking of that concentration, year-to-date has really been concentrated in a few stocks. The Magnificent Seven, which comprised of Apple, Google, Microsoft, Amazon, Tesla, Meta, and NVIDIA, have really driven performance. You can see the gap between the Magnificent Seven and the S&P 500. And then when you look at the rest of the S&P 500, 493 other stocks, barely positive through the end of the third quarter. So important distinction to make here to understand what is driving equity market performance. On a positive note, this gap between the Magnificent Seven and the rest of the market didn't widen further in the third quarter, but at the same time, it didn't narrow either, holding stable. Here's another way to look at it. Here's the year-to-date strength that was concentrated in a few stocks. This is the top 10 positions of the S&P 500 as a percentage of what they drove performance. So in 2023, the top 10 contributed 96.5% of the total return of the S&P 500. That translated into 11.7 percentage points of return. If you look at this table, that is by far and away the most dominant share of any period in history to have so few stocks contribute so much in return. We would not chase this. We don't believe in having a concentrated portfolio. Diversification will win out the day over the longer term. Important to know, however, just how concentrated and what a limited number of stocks have really driven performance for the domestic indices. Let's go a little more granular on the equity market. And one positive development is that earnings expectations are trending higher. These are earnings expectations for 2023 and 2024. In our view, earnings drive the stock market, and this is really the key focal point. For 2024, we think those earnings expectations are too high. They imply a double-digit growth of profits. We think single-digit growth is more likely, and we believe the stock market will track that single-digit growth in terms of a total return approach. We really think earnings will drive it. The Magnificent Seven are expensive when you look at them on a PE ratio basis, but the rest of the market, not overly expensive. We think is a relatively reasonable valuation, and therefore the rest of the market can track those earnings higher. Again, do think that that 2024 expectation is too high. As that gets revised lower, that could create some volatility in the equity market. But at a minimum, this tells you that a lower bar has been set for earnings. And when you see those expectations turn higher, that is a modest positive for the equity market. And from a tailwind perspective, certainly September lived up to its reputation as a difficult month. September has always been the most difficult month from a total return perspective, but the fourth quarter has historically been the strongest 3 months of the year to own stocks. And you see that here on this chart. And of course, here in early October, we've seen a rebound in the equity market from its high in July. The S&P corrected 8%, up about 3% from that bottom just here in October alone. So far holding up to that expectation. I should add that at the end of September, there was a lot of pessimism and negative sentiment in the market that can act as a contrarian indicator. For those of you that were with us in our initial outlook for 2023, you'll recall in January, there was a lot of negative sentiment about the equity market, light positioning, and that contributed to initial strength in the equity market. That turned to optimism over the course of the year, and then again turned bearish at the end of September, can set the market up for a rebound, especially when it reaches an oversold condition. So markets bouncing off of that, an encouraging sign. Again, we're looking for mid-single-digit returns for broad equities over the coming year. Within the equity markets, we have a slight bias towards dividend payers and value stocks. Here we measure the attractiveness of growth relative to value. And on that line is pointing towards value being more attractive. And again, this is typically where you'll see your dividend payers. So slight bias there. Again, not looking to make a big bet. We don't believe in that. But this is where we think better value lies. I should caution that valuations are not a near-term indicator for performance. They never are reliable for near-term performance. And by that, I mean 6 months to 1 year. However, they do correlate with longer-term performance over 3 to 5 years. So that is our slight bias towards value in our portfolios. And since we're getting a lot of questions from clients on the geopolitical events, and our thoughts and prayers out to everyone in Israel and the human tragedy that has unfolded there in recent days, we do get questions. What does this mean for my portfolio? Should I abandon the markets? Should I change my strategy? And the answer to that is no. If you look at historical geopolitical events, they do have a negative short-term impact on average. And here we list a variety of events from 1990 on. You can see that most of the decline is concentrated within the first few days, even month or 3 months of the event. And over a 1-year period, though, they don't have a big impact. And most of those big declines at the 1-year time frame associated with major economic recessions, which were created for a variety of other events other than these geopolitical events. So do take it with a grain of salt from an investing standpoint. Don't change your strategy. These tend to have more of a short-term impact. And even the recent one, or even the last few days, we've seen a relatively resilient equity market. Let's turn to the bond market and the increase in yields, and want to talk about a few themes that we've seen from the bond market. And again, another hot topic with clients. This is the implied rate on the December 2024 Fed Funds futures contract. You can see that it has steadily increased since late May of this year, and really a key driver of what pushed Treasury yields higher over the summer. So the current Fed funds rate between 5.25 and 5.5. At one point in May and June, the market expected about 1 percentage point worth of rate cuts as the markets began to take the Fed officials at their word that they were going to keep rates higher for some time, the implied yield increased. And as of right now, if you just look at the gap between those two, the blue line and that pink shaded area, it's implying that the markets are factoring in about 2 rate cuts by the end of 2024. I think that's a fair expectation. This was a major driver of yields moving higher as investors removed rate cut expectations out of the bond market. But there were other factors as well: rising issuance, building in a bigger risk premium for debt servicing that will increase on a go-forward basis, and then stubborn inflation. There is some uncertainty how much inflation will decelerate. Rising oil prices certainly contributed to that. All of that contributed to higher yields as investors price in a bigger buffer. What that's translated to is the worst bond bear market on record. This is the percentage decline from the peak, and it shows the Bloomberg Aggregate Bond Index. You can see just at the far right how much it's declined, down 16% from its peak. Over the last 5 years, net bonds are now negative. Just an incredible decline that is, when you look at it in this picture, which shows that percentage decline, we haven't seen anything like it. With that said, now is not the time to throw in the towel and abandon your investment strategy. If you just look at this, investors have come a long way. They've absorbed a lot, and yields are now much higher. Speaking of which, the 10-year Treasury yield is now above the average from 1990. So a 30-plus year average rate of 4.2, the 10-year Treasury at 4.7 is now above that. And I think that speaks volumes to how much of a correction has taken place in the high-quality bond market. Highest yields since 2007. And not only are they the highest yields, but if you look at 10-year TIPS yields, those are Treasury inflation-protected securities, which is not shown on this chart. They show about a 2.5% buffer over inflation. That's the best valuation also since 2007. So a real change in fixed income in terms of from an investor standpoint. So as painful as it's been, we do think it gets better. And that's best represented by this chart here. And to remind investors, and we haven't used this since our initial year outlook for 2023, that yield leads future return. This is the 10-year Treasury yield in dark blue. We shifted it 10 years forward. And then the yellow line is the Aggregate Bond Index 10-year annualized return. So it's an annual return number. Some years will be higher, some will be lower, but average over 10 years does track towards yield. And it shows you that the 10-year annualized return, which right now stands at about 1.1%, is set to steadily improve. Now, the naysayers will say it'll take 10 years to get that. No, it's not the case. You will begin to see that improvement over a shorter time frame of 3 to 5 years. But those now higher yields in the 4 to 5% range, and even above that, will begin to have a fairly significant impact. So yield leads future returns. Important to understand that the outlook for bonds has improved dramatically, even after a very painful stretch for bond investors. And one last point, by the way, on the bond market, I should mention that our focus remains on high quality bonds. We think if you're going to have risk or credit risk, take it on the equity side where the potential upside is greater in our view. So our focus very much remains on intermediate and high quality bonds. Then one last point on fixed income. We continue to get questions about cash. Short-term bonds yield more than intermediate, although that gap is changing. We'll go ahead and talk about that here. And since 1990, the average total return difference, or actually if you invested in T-bills or cash, let's call it, for a short period of time versus intermediate, when the yield curve is inverted, for all one-year periods since 1990, the intermediate portion of the yield curve, or the intermediate bonds, have outperformed 93% of the time, with an average total return difference of 4.9%. It's counterintuitive, but buying those intermediate bonds, even when the yield curve is inverted, does work, partly because that yield curve is inverted, and when it's inverted, we get a recession, which ultimately leads to rate cuts, which benefit those intermediate bond prices. If we go back to the 70s, this data is a little more mixed, but important to realize that just sitting in those short-term cash bonds, you are making a call, and by the time the market moves, say intermediate yields fall, if they do decline, you'll be too late. The market moves in advance of those rate cuts, so it becomes a bit of a market timing exercise. And again, we're here to invest for the longer term, and important to note that history does support that exposure to intermediate bonds. That concludes my prepared remarks. Let me pause there. We're going to transition to the Q&A portion of the program, and let me bring on Rebecca Robinson, Head of Wealth Management. Rebecca?
All right, well, Anthony, thank you. And as always, we have a lot of questions, so I think we should just get right to it. And I'll actually start with a fun one. You referenced the Magnificent Seven, and we do have a comment that says, is FANG dead? So FANG was Facebook, Apple, Amazon, Netflix, Google. Now we talked about the Magnificent Seven. Is that more of a focus right now?
It's not more of a focus. Are they dead? No, I don't think they're dead, but it's important to realize that the strength of the company doesn't always make a great investment. And these stocks are very expensive now. And if we do have a difficult environment on the economic front, or if things get challenging from investors willing to pay a premium, that we think the rest of the market will outperform the Magnificent Seven. And I'll give you an example. NVIDIA had a really strong earnings report in August, beat expectations, boosted future guidance, and the stock really didn't move. In fact, it was down. So at some point, the good news is priced in, and you need another catalyst. I think it's telling that gap didn't widen further in the third quarter. So we'd rather be diversified, take the other side of that, and not try to ride that wave of a limited number of stocks.
All right. So really now for our third quarter in a row, recession is a big topic. Is a recession coming? Is there a possibility? We talked a little bit about, we still see so much good news, but it doesn't mean we're out of the woods. If we were to just pull back, what is your view on the likelihood of a recession in 2024? And then kind of what are the key triggers and what does that mean for us?
So I think one of the key triggers is still the labor market. Yes, I do think the recession is a probability for 2024. I'd put it at roughly 1 in 3. Because we haven't seen the full impact of Fed rate hikes, we do have higher short-term rates, which are taking a bite out of the consumer and corporate profits. So it is something to be on guard for. We are seeing signs of slowing, even after a resilient economy here for the last several quarters. Weekly jobless claims would be one of our first leading indicators. To me, that's one of the best leading indicators of the health of the economy. Not showing any cracks yet, but that's one to watch. ISM services would be another one. That also, if it dipped below 50 or got close to that, would be a sign that the services industry, which is about 80, almost 90% of the economy, would be slowing, and I think a true tell on potential economic growth. And then a third, which I talked about, Rebecca, the yield curve still inverted, and I don't want to dismiss that indicator. That is a sign from the market that things will slow. And again, saying it's different this time is dangerous language that we don't want to get sucked into.
And along the kind of interest rate theme, there are a lot of questions around interest rates, and like everything else, if anyone really knew, we'd all make decisions with that. But what's the direction, in your opinion, sort of interest rates? Where do we see them at the end of 2024? Will the Fed cut rates in 2024? How do we think about interest rates?
Yeah, Rebecca, great point. That's one thing that very intelligent people across this market have gotten wrong for many, many years. So don't try to forecast interest rates. My best view here is that, yes, I do think the Fed cuts rates in 2024. I think we're at or near a peak in interest rates. The Fed, in my view, is probably done or was done in July, even though they have talked about producing another rate hike. This past week, for the first time, we've heard Fed officials talk about that they may have done enough. And that even comes from some members who lean a little more hawkish or having a bias towards raising rates. I think that's an important shift in tone. I don't see rates coming down a lot, however. I think rate cuts will help, but there is still uncertainty about the path of inflation. There is uncertainty about our rising debt costs. And I think as long as that uncertainty persists, I think we're kind of stable on interest rates now. And it's probably not till 2024 when we do see or get more clarity on inflation and get closer to potential rate cuts that we might see a modest decline in rates. And when I say modest, I'm talking about a 0.5 percentage point based on what we know today. So that's our view, not a big change, more of a range bound with a potential decline in 2024.
All right. So along this same interest rate themes, one of the things I hear from clients a lot right now, portfolio is volatile. I can be down 2-3% in a day, up. I'm seeing what I feel like are losses. And then I look over at cash, and cash is at 5.25. And why don't I just go to cash, wait this out? I could make more, I wouldn't be down, and then move back in to the market, when things have stabilized a little bit. So that, I mean, that's a pretty common theme. And I think, big picture, we sort of know, but I think for the first time too, we're seeing cash return something a little bit more meaningful. So if we look at interest rates, but if we also sort of look at strategy, how do we think about cash, and how, if someone is feeling that way, do they sort of help understand the bigger picture?
Yeah, I think we think about cash more as it's certainly elevated right now, but it's not an investment. It's not a long-term solution. It's not a long-term strategy. So when we don't really allocate towards it in the portfolio. And if you were to go back a year from now and all the uncertainty about the stock market and the economy, well, stocks have actually done quite well over the past year, and you would have been better off investing. Now, granted, you could say that the return in fixed income would have been versus fixed income, a little bit been better, even the last 6 months. But you start to bring in the question of market timing and whether you're a trader or an investor. And if you're an investor, then you commit to your investment plan. And as I mentioned, or was alluding to in the webinar, trying to time when cash is going to no longer be of value and you want to be in bonds is really a fool's errand, because the market's going to move in advance of those shifts. And by the time you react and miss out on locking in some what are really attractive intermediate yields here now, it'll be too late. And I think you'll end up shooting yourself in the foot. So it's alluring, but at this stage, how far we've come in the bond market, would not pursue that as a strategy. Stick to your investment goals and staying invested accordingly.
Well, and I really like what you said. Are you an investor or are you a trader? And I think we really encourage people to have a plan, pick your allocation and your investment strategy based on that plan, and then ask yourself, has your plan changed? Because we do look at a market in a 5-year cycle, not a 5-month cycle. So that's kind of all important to keep in mind. Let's move on a little bit to some of the world economy. Just this week, we're hearing some continued concern about defaults among some of the bigger Chinese real estate companies, something like Evercore. When we start to hear these things and this view that maybe the world economy is having issues, how big a risk is that? And what are the investing implications?
Yeah, so a couple fronts there. The I don't know if I'd say a bubble, but the bursting of the property bubble in China is having an impact. Evergrande defaulted a year ago. The Chinese authorities are still trying to create an orderly wind down. There's two impacts. One is to emerging market equities. One is to global growth. That is about a 25-30% portion of the Chinese economy. And China is the second largest economy. So it will have an impact on global growth. And you are seeing weaker overseas growth, which is a risk in turn for the US, not just China now, but Europe has slowed as well. So that is a negative for global growth. From an investing standpoint, I don't know if most people know that China is about 30% of the emerging market equity indices. What we've done is limited exposure to China in our portfolios. I don't see this having a contagion risk. I think the Chinese authorities have already eased policy. They'll likely do that again and ensure that an orderly wind down so it doesn't impact their economy. But I think most of the investments will be in the emerging market equity area, where we've taken steps to limit that exposure. But by itself, I don't see it derailing, say, the US equity market. Just another headwind from a global growth perspective.
Got it. And if we think about other sort of things in the economic climate, we also know we're coming up on an election year. And I think we always like to touch on, there's some hesitancy sometimes, like wait until after the election, or let's see how things play out. What do we think about the elections, and will it lead to market, unease?
Yeah, amazing that we're a year away from another presidential election. We get that one a lot. Our mantra is profits over politics. It's more about what the economy does. It's more about what corporate profits do, valuations in the equity market, the level of interest rates. All of those are going to really drive what happens in stock and bond markets. Stock market's not partisan. If you look back at various political regimes, whether it's Democratic president, Republican president, different makeups of Congress, and performance is pretty even across the board. So an important one to remember. I'm sure we'll be revisiting this topic over the coming months, and certainly show charts to show that. But do not let politics influence your investing. I've seen that happen with certain clients, and it's just led to weaker returns over time. So stay the course and keep politics out of the investment profile.
Yeah, I think one of the things we find is, especially when volatility has gone on for a while, people feel an urge to do something, take some sort of an action. And there's a question in the chat that kind of goes along with this as well: is there anything you would absolutely tell an investor not to do? Absolutely not to do.
I think not to do would be to try to time the market. I've seen that firsthand over my career, that clients end up doing that and shooting themselves in the foot. Stay to your goals. Have your long-term goals changed. And I think it's really helpful that when you do invest, know that this is for 3, actually 5 years or longer. And you shouldn't invest if that's not your time horizon, and that what you invest that money for should be very clear, have a specific goal. And I think financial planning is an integral part of investing. And therefore, if your longer term financial goals haven't changed, stay the course. It's painful. I know this can be emotional, but the math does work out over the longer term. We've got over 100 years of data to show that. There are times returns are better or sometimes lower. But having a diversified portfolio and making those adjustments really does work over the longer term, even if over the short term it can be painful and tough to watch. I know it's tough to sit through that, but you're really better served if your goals haven't changed to stay committed.
So let's think about too. One of the questions is around low volatility stocks, and are they a good choice to insulate your portfolio if we're looking at a recession? And I think there's even a bigger question here: is how do we think about looking at a recession, an election, all of these different things that are happening, interest rates? How much do we incorporate that into our portfolios versus how much is there sort of a steady strategy that we look to stick to?
So we first and foremost have a steady strategy, but we do take those into account. If there's a recession, we factor that into potential economic growth and potential equity returns. So our expectations for the equity market are a little lower than I think consensus markets prior to 2022, where the equity market had been up over double digits, really attractive rate of return. That's above the historical norm. And we think with higher interest rates that we'll see lower, but still positive equity returns. And if you want to beat inflation, equities are still where you want to be. I think, Rebecca, clients forget that stocks are still off of their all-time highs. They have not made new all-time highs. And therefore, a lot of that negative news about a recession is still somewhat factored in. And when I look at the broader market, if we do get a recession, I think maybe there's another 10% downside, but I don't see an egregiously overvalued broader equity market. I mean, the Magnificent Seven are certainly expensive, but there's been some damage already. Don't forget about that we're still off those highs. And while there could be more downside because of that, I think you'd need to have a really severe recession to have another bear market. I don't see another bear market developing from this point.
And Anthony, I think that's a great point too, is so much is already priced into the market. So some of what we're seeing in headlines, things like that, they're not shocks. They're things like interest rates. There are at least some sort of estimate put in there about what we think is going to happen. So I think it's important for our investors to keep that in mind as well. It's another reason why market timing doesn't work. By the time you take action, a lot of it's already priced in and you're a little behind. We have one final question, and this is another interesting one, and it's a theme that sort of has come up a few times over the last 2 years. And how do we protect from de-dollarization of the world economy? So we talk about people moving away from the US dollar, different countries. How do we protect against it? And also, what does it actually mean?
Yeah, that's it is one that comes up a lot. I don't think you have to necessarily protect against it. The world is moving away from the US dollar, but it is doing so at a glacial pace. And the reason that's the case is just there's simply no alternative. There's no currency that is as deep as liquid. There's no bond market that's as deep as and liquid. And therefore, I think the US dollar will still be the center of international trade for years and years to come. At the margin, those changes will happen, but it'll take decades to replace the US dollar. There is no viable alternative. The dollar has been strong as of late, the last couple of years. So to see some dollar weakness would be normal at this stage, and I wouldn't be alarmed by that. But that doesn't mean that it's the end of the US dollar by any stretch. The correct move over history is anytime these types of risks have come up, is to take the opposite view and realize that the dollar is not going to end as the world's reserve currency. Again, if we do get some weakness, would not be alarmed by that. I think it's part and parcel of fluctuations in currencies over time, but just not going to happen. I do think deglobalization will continue, but that doesn't mean the end of the US dollar or losing the dollar as its reserve currency status.
All right. Well, thank you, Anthony. And thank you, everyone, for joining us. And as always, we appreciate you being our clients. We're here to answer questions, and we're here to help how you can take and apply this information to your personal situation. So thank you, everyone, and have a great day.